Thank you very much, Mike. I always look forward to coming to Chicago specifically for these meetings until it dawns upon me that Mike Moscow is going to introduce me again. Then I say all bets are off, and who knows how it's going to come out. The source of all those quotes that you ascribe to independent sources indeed did come from my mother. On less serious issues, I thought that what we're dealing with in the international arena is, as Mike Moscow has pointed out, a major learning experience for all of us, which is an issue I'll get to later. But clearly, any evaluation of the international financial crisis of the past 2 years would be incomplete without an understanding of the extraordinary strength of the U.S. economy that has acted as a buffer for much of the rest of the world. There can be little doubt that the marked widening in our trade deficit on goods and services has played an important, possibly a critical role in supporting world stability during these trying years. Domestic demand growth in the United States has accounted for about 1/3 of the total since 1996. Now that there are tentative signs that we may be through the worst of the crisis abroad, an issue to which I will return shortly, it would be useful to address the benevolent but bedeviling question of how the American economy, at least to date, has managed to remain an oasis of prosperity in sharp contrast to badly sagging economies in the developing world, recession in Japan, and tepid growth in much of Europe. And can we project how long our economy will be able to provide support to the rest of the world? Forecasts of inflation and of growth in real activity for the United States, including those of the Federal Open Market Committee, have been generally off for several years. Inflation has been chronically overpredicted and real gross domestic product growth underpredicted. An increase in inflation doggedly forecast to follow the ever lower unemployment rate, now the lowest in 3 decades, has not occurred. In fact, even after accounting for the reduced bias in our price statistics resulting from methodological improvements, some measures of inflation have even continued to ease. Subdued inflation, of course, has resulted in part from the sharp fall in oil prices from mid-1997 through early this year. Moreover, there has been a significant weakening in non-oil import prices since 1995, owing largely to a combination of declining world commodity prices and a strengthening dollar in our foreign exchange markets through last summer. The decline in prices of oil and non-oil imports has clearly one-off events. There are clearly one-off events. Indeed, as you all know, oil prices have moved up fairly sharply of late. The remaining easing in the inflation rate owes to disinflation in domestic value-added, excluding oil. The latter, in turn, is more than accounted for by a decline in the rate of increase in unit costs of output, inasmuch as profit margins have increased significantly since 1993. A pickup in the growth of labor productivity beyond the effects of the business cycle appears to have been an essential factor behind the slowing in inflation. Growth in labor productivity, which had averaged less than a 1% annual rate in the early 1990s, rose to approximately 3% in the 4 quarters ending in the first quarter of 1999. Increased labor productivity growth has directly lowered the growth of unit labor costs, and that reduction in costs in combination with declining import prices has also apparently engendered lower price inflation and inflation expectations that in turn have curbed both nominal wage growth and unit